Welcome to the Deep Dive. Today, we're pulling back the curtain on one of the really big names in finance, Bank of America.
That's right.
We're diving straight into their second quarter 2025 earnings call. It's basically a direct line, to the core insights from their CEO and CFO.
Exactly. You get the thinking right from the top.
Our mission, well, it's to cut through all that corporate speak, find the important nuggets for you, and really show how one of the world's largest banks is navigating this, well, dynamic economy, and also how it's fundamentally reshaping its future through tech.
Yeah, that tech piece is huge.
It's kind of a shortcut to being well-informed, and honestly, there's some surprising facts along the way. Okay, let's unpack this.
Sounds good. And what's really fascinating here, I think, is that we're getting a snapshot of their strategic thinking. It's not just the raw numbers.
All right.
They laid out a pretty clear economic backdrop, which kind of sets the stage for their performance. Their worldwide research team, they're predicting no recession.
Oh, interesting.
Yeah, they see a modestly growing economy, maybe 1.5% by year end, and they don't expect any Fed rate cuts until next year.
That's a pretty clear outlook, maybe more optimistic than some might expect. What gives them that conviction, do you think?
Well, looking at their core business helps.
The consumer and commercial side.
Exactly.
Right.
What's standing out there? They pointed to solid consumer spending data and credit quality. It's actually improving.
From already strong levels.
Yeah, from what were already pretty strong statistics, we're seeing plenty of household net worth growth too, market performance helping there.
Okay.
And crucially, account balances are staying strong, even above pre-pandemic levels, which is significant.
Right.
Then on the commercial front, it's mostly solid loan growth, good credit quality, with one notable exception they flagged.
Let me guess. Commercial real estate.
You got it. Specifically, the office sector. That's clearly an area they're watching very closely.
That distinction is definitely important. Okay, so with that economic pulse in mind, let's get into the big numbers for Q2 2025. What did BOFA actually deliver?
The headlines, well, they paint a strong picture. Revenue came in at $26.6 billion. That's on a fully taxable equivalent basis.
Right, the FTE basis. Helps compare things properly.
Exactly. So it accounts for tax-exempt income, gives you that clearer apples-to-apples view, and that figure is up 4% year over year.
Okay, solid growth.
Net income after tax was $7.1 billion. That leads to earnings per share, EPS, of 89 cents.
And that's up too.
Yep, a healthy 7% increase year over year. Their key performance ratios looked solid too. Return on assets, 83 basis points.
So 0.83%.
Right. And return on tangible common equity, ROTCE, was 13.4%. That's a really key profitability metric for banks, stripping out intangibles.
Shows how well they're using shareholder money.
Yeah.
And was there a particular standout for them this quarter? Anything they seemed really proud of?
There was, yeah. Net interest income, or NII.
Well, always a big one for banks.
Definitely. It hit a record $14.8 billion, growing 7% from Q2 last year.
Wow, a record.
And get this. It's their fourth consecutive quarter of NII growth, a very consistent trend.
That is consistent.
And what's insightful here, I think, is how Bank of America has just consistently capitalized on this interest rate environment. They've kept the momentum going while, some competitors are seeing NII pressure.
Shows that deposit base advantage they have, maybe?
Could well be. It certainly showcases something unique.
Okay, so beyond the core figures, they also talked about capital strength, shareholder returns. What did they emphasize there?
Yeah, they returned a lot of capital. In Q2 alone, $5.3 billion in share repurchases.
Okay.
And another $2.0 billion in dividends paid out.
So over $7 billion just in Q2.
Right. And if you look at the first half of 2025, the total capital returned is $13.7 billion.
Which is way up from last year, isn't it?
It is a significant 40% higher than the first half of 2024. And there's more. They announced plans to hike their quarterly dividend by 8%.
Starting soon.
In September, yeah. Pending board approval, of course. But it definitely signals confidence in their performance and their capital position.
Okay, so that capital strength is clear. They're signaling confidence, which, begs the question, where's all this confidence coming from operationally?
Good question.
And that seems to lead into their focus on strong organic growth across all their businesses, right?
Absolutely. That client-first strategy driving growth. Let's start with consumer banking.
Yeah, what were the highlights there?
They certainly flagged some impressive numbers. A big milestone was crossing 5 million net new checking accounts over the last 6 years.
5 million net new. That's quite something.
It really is. And what's fascinating is average consumer deposits have grown for a third straight quarter. And balances are up year over year for the first time since, well, 2022.
So putting the pandemic surges behind them now.
Exactly. The average balance per checking account is now over $9,200.
Wow. Up from what, pre-pandemic?
Around $6,000 to $7,000, so quite a jump. And they said 92% of primary checking accounts are held within the household.
Which tells you what?
It speaks volumes about deepening client relationships, right? Customers aren't just opening an account, they're bringing their whole financial life over, making BOFA their main bank.
That really illustrates a strong connection.
Okay, so beyond everyday banking, what about wealth management and lending?
Also strong. In wealth and investment management, client balances hit a staggering $4.4 trillion.
First million, okay.
Yeah. Driven by robust assets under management flows, good loan demand, and obviously positive market appreciation helped too.
Makes sense.
They also noted home and auto originations grew year over year. And they're still a leading lender to small businesses. Those loans are also up year over year.
So pretty diversified strength in lending.
Looks like it.
And shifting gears a bit, global banking and markets, similar momentum there.
They did see similar momentum. Global banking added over 1,000 net new clients.
Okay.
Primarily driven, they said, by their payments capabilities. So things like Cash Pro, transaction services.
Exactly. It indicates that strategic investment is really paying off, making it easier for businesses to move money through BOFA
Right.
and global markets. Another record second quarter for sales and trading revenue.
Another record. They seem to be hitting a few of those.
They do, and it's their 13th consecutive quarter of year-over-year sales and trading growth.
13 quarters. Wow.
Yeah, driven partly by strong financing demand from institutional borrowers, especially in things like asset-based securitization and credit facilities, shows a consistent ability to, capture market opportunities.
Okay, so consistent momentum across banking and markets. But maybe the most transformative story coming out of this call, and frankly one that's reshaping the whole industry, is their long-term investment in technology.
Yeah.
And now we're seeing the beginnings of their AI practices really showing results. How are those paying off?
It's actually quite remarkable, this long-term tech investment. It's directly linked to a really surprising fact about their headcount.
Oh, yeah. What's that?
The company's headcount has fallen from 300,000 15 years ago to 212,000 today.
Wait, from 300K to 212K? That's almost a third less.
Exactly. Think about that reduction. It's not just cutting costs. It's really a leading indicator, I think, of how these large banks are fundamentally changing their operating models with tech.
Challenging that old link between growth and headcount.
Precisely. They attribute it to their continuous rollout of, robust, scalable, secure technologies, plus digitization, simplifying products, machine learning, process improvements, the whole package.
It sounds like a blueprint for efficiency that other industries must be watching closely.
I'd imagine so.
Those numbers are staggering. Does this signal a broader trend, or is BOFI just particularly ahead on this?
Yeah.
And how are customers reacting? Are they embracing this digital push?
Well, the digital engagement numbers are pretty impressive. Nearly 80% of consumer households are now fully digitally engaged.
80%. Okay.
And they logged 4 billion logins in Q2 alone.
Billion with a B?
Yep. Plus, 65% of consumer product sales happen digitally. So it shows a clear shift in customer behavior, customer preference. Suggests BOFA is really at the forefront here.
Okay. Given that huge investment in tech, how are they actually structuring their approach to AI? Did they break down their strategy?
They did. They kind of categorize it into 4 pillars.
Which are?
AI agents, search and summarization, content generation, and crucially, coding and automated processes.
That sounds like a very structured way to go about it.
Yeah, integrating AI across the whole operation.
And are they building on existing tech? Like, what about Erica, their virtual assistant? Is that part of this?
You're right on track. Erica, which they introduced back in 2018.
Yeah, I remember that.
Now averages over 58 million interactions per month, helping clients bank easier.
58 million a month.
Yeah. But what's really interesting is how they've expanded Erica beyond just consumers. She's used for commercial clients through Cash Pro.
Yep.
And even internally for employees. Get this. 90% of their 210,000 plus teammates use Erica for employees for things like password updates.
90%. So it's really woven into their everyday operations, benefiting everyone, not just customers.
Exact.
Can you give us some more concrete examples of AI in action beyond Erica?
Sure. In wealth management, they said AI tools are helping relationship managers deliver more personalized planning, even pitches.
Okay.
In operations, there's a chat-based AI product used by 750 people just to reconcile trades, and they specifically stated it's already saved many FTEs.
Full-time equivalents.
Right, meaning the work of many full-time employees is now done with much less human input.
Wow.
And on the coding side, 17,000 programmers are using AI coding tech. They report savings of 10% to 15% in code generation costs.
So it's directly hitting efficiency, cost savings across different parts of the bank.
Absolutely.
It's clear they're not just, experimenting with this stuff. This feels like a massive long-term commitment.
It really does. They emphasize the investment. They hold 1,400 AI patents.
1,400.
Yeah. And they've already created over 250 AI and machine learning models within the company. This isn't just a trend for them. It seems like a foundational shift.
Okay, so let's delve a bit deeper now into their overall financial health and the outlook. First up, expenses. How do they manage those, and what does it mean for operating leverage going forward?
Right, expenses. They came in just under $17.2 billion in Q2. That was actually down from Q1,
Oh, okay.
but still up about 5% year over year.
Why the year-over-year increase?
Mainly reflects revenue-related incentives,
Yeah.
General inflation, and those continued investments in tech and people we've been talking about.
Makes sense.
But the expectation is for expenses to kind of flatten out, maybe even dip a touch lower in the second half of the year.
And combined with the NII growth.
Exactly. That combination is projected to provide significant operating leverage. Basically, profits growing faster than expenses. They're getting more efficient at turning revenue into profit.
Getting more bang for their buck, okay. And asset quality. We touched on commercial real estate, but what's the bigger picture for charge-offs, when they write off bad debt?
Asset quality overall remains sound. Net charge-offs have been hovering around $1.5 billion for the sixth quarter in a row.
Already stable then.
Yeah, but it's what they called a tale of two cities.
Meaning?
Lower consumer net charge-offs are being offset by those higher commercial real estate office charge-offs we mentioned.
Right.
The good news there, though, is that most of those CRE losses were previously reserved for. So the hit to profitability was pretty modest.
Okay, that's important context.
And here's a noteworthy detail. The net loss rate on credit cards actually declined year over year.
Really? Declined?
Yeah, for the first time since early 2016, if you exclude the weirdness of the pandemic period, it indicates improving health in a key consumer area.
That is a good sign for consumers. Okay, what about their net interest income forecast for the rest of the year? Still on track. What are the main drivers?
Yep, still on track. Their expectation for the NII exit rate in Q4 2025 remains unchanged. They project it'll be in the range of $15.5 billion to $15.7 billion.
What you mean?
A record NII for the company for the full year, and a full-year NII improvement of somewhere between 6% and 7%.
Pretty strong finish to the year expected then. What's driving that?
The main drivers they cited are fixed-rate assets, repricing higher, ongoing loan and deposit activity, and continued benefits from the global markets business.
Okay. They also talked capital flexibility, the regulatory side of things. How strong are they there? What are their plans for using that capital?
Very strong. Their CET1 level, that key common equity tier 1 capital ratio, is stable at 11.5%.
Which is well above the minimums, right?
Well above, yeah. And their supplemental leverage ratio, the SLR, is at 5.7%. That gives them plenty of capacity for balance sheet growth.
And are they planning to use that capacity?
It seems so. They noted their target buffer for CET1 is just 50 basis points. That signals they intend to use any excess capital for growth, not just let it sit idle.
Actively managing it to support the business.
Okay. And speaking of efficiency, they have an ambitious target for their efficiency ratio, right? Measuring expenses versus revenue.
They do. They're aiming to drive that ratio back down to pre-pandemic levels.
Which is where?
Low 60s, they said, potentially even below 60%.
And what's helping them get there?
Part of it is actually the sunsetting of certain accounting treatments for tax incentive clean energy deals. Those had impacted the ratio previously, but it's a clear efficiency goal. Shows their commitment to streamlining.
Got it. Finally, let's talk future of payments. They touched on stablecoins. What's their take on that emerging tech?
Yeah, interesting point. They view stablecoins as potentially a new payment rail.
But are they jumping in?
Well, they're building capabilities. They have partnerships already. but they were pretty clear they aren't seeing clients knocking on the door for this right now.
Oh, okay.
And, the legal clarity just isn't there yet either. So
Yeah.
their approach seems very much client demand driven.
Exactly. They drew an interesting parallel to Zelle. They noted how Zelle outpaced Venmo in transaction volumes just by moving money efficiently within the traditional banking system.
Suggests they aren't rushing into stablecoins just for the sake of it.
Right. It's a pragmatic, not speculative approach to these new payment ideas.
So as we wrap up this deep dive into Bank of America's Q2 2025, wow, we've covered a lot. From that record NII driven by their strong deposit base to those really remarkable efficiency gains powered by tech and that surprising drop in headcount.
Yeah, that was striking.
And their pragmatic, client-driven approach to things like stablecoins. We've really seen a snapshot of a company that's not just reacting, but actively shaping its future.
Especially through that strategic use of AI and disciplined organic growth everywhere.
Yeah.
The picture that really emerges is, I think, a financial institution deeply committed to using innovation, using it to enhance operations and serve that huge client base more effectively. It's a powerful example of how established players can adapt and lead.
Definitely. Okay, now for a final thought for you, the listener. When you consider how deeply Bank of America is embedding AI into its core operations, everything from client chats to internal coding, what does this imply about the future skill set needed in the financial industry?
Good question.
And maybe broader than that, how might these same technological forces fundamentally transform even the smaller, more niche businesses you interact with every day? Something to think about.